Welcome to a comprehensive deep dive into one of the most elegant, straightforward investment portfolios you can build today. If you're looking to simplify your financial future and understand exactly how to construct a powerful two-fund portfolio using Vanguard's flagship offerings, you're in exactly the right place. This video will walk you through every aspect of building and maintaining a VTI and BND portfolio over the next 20 years. If you're serious about building real wealth through smart, boring investing, subscribe to this channel right now so you never miss another foundational wealth building video like this one. Let's start with the absolute basics. VTI stands for Vanguard Total Stock Market Index Fund. This single fund gives you exposure to essentially the entire US stock market in one purchase. When you buy VTI, you're buying a tiny slice of thousands of American companies, from massive Fortune 500 corporations all the way down to smaller mid-cap and small-cap firms. BND, on the other hand, is Vanguard's Total Bond Market Index Fund. This fund holds thousands of bonds issued by the US government, municipalities, and corporations. Together, these two funds create a complete, diversified investment foundation. Why choose just these two funds instead of spreading your money across dozens of different holdings? The answer lies in elegance and efficiency. Most investors vastly overcomplicate their portfolios. They chase performance, chase trends, and chase the latest hot stock tips. What they should be doing instead is building a simple, rebalanceable, low-cost structure that lets compound growth do the heavy lifting over decades. A two-fund portfolio accomplishes this with remarkable clarity. Asset allocation is the first critical decision you'll make, and it's arguably the most important one. Asset allocation simply means deciding what percentage of your money goes into stocks versus bonds. There's no single perfect allocation because it depends entirely on your personal situation. Your age, your risk tolerance, your investment timeline, and your financial goals all factor into this decision. However, there are some widely accepted guidelines that have proven successful for millions of investors. A common starting point for someone in their 30s or 40s might be something like 70% VTI and 30% BND. This allocation gives you significant stock market exposure for long-term growth while maintaining a meaningful bond cushion to reduce volatility. Someone in their 20s might lean more aggressively toward 80 or even 90% stocks, with just 10 to 20% bonds, because they have decades to recover from market downturns. Moving toward 50% stocks and 50% bonds, or even more conservative mixes. The genius of this framework is its simplicity. You're not choosing between individual stocks. You're not trying to pick winning sectors. You're not debating tech versus healthcare versus energy. You're simply deciding one number, your stock-to-bond ratio. Once you've made that decision, you can trust the mathematics of diversification to handle the rest. VTI gives you the growth engine. BND gives you the stability anchor. These two work together like breathing in and breathing out. Now let's talk about what happens after you've built your initial portfolio. Over time, the two funds will grow at different rates. In years when stocks outperform bonds, your VTI holdings will grow faster than your BND holdings. This means your actual stock-to-bond ratio will drift upward. In years when bonds outperform or when stocks decline sharply, your ratio will drift downward. This drift is where rebalancing enters the picture. Rebalancing is the practice of bringing your portfolio back into alignment with your target allocation. Let's walk through a concrete example. Imagine you started with $10,000 split into a 70-30 allocation. That's $7,000 in VTI and $3,000 in BND. You set it aside and let it grow for a full year. During that year, let's say stocks surge and bonds rise modestly. Your VTI grows to $8,000 and your BND grows to $3,200. Your new total is $11,200, but your actual ratio is now roughly 71% stocks and 29% bonds. You've drifted slightly. Rebalancing means selling some VTI and buying some BND to bring you back to 70-30. In this case, you'd sell roughly $100 worth of VTI and use that money to buy BND. It sounds simple, and it is, but the psychological weight of rebalancing cannot be overstated. Rebalancing forces you to sell the thing that's winning and buy the thing that's struggling. When stocks are surging and making headlines, selling stocks feels wrong. When bonds are quiet and boring, buying more bonds feels painful. Yet this is precisely where rebalancing creates value. Rebalancing works because it automatically forces you to buy low and sell high. When stocks have outperformed and make up too much of your portfolio, rebalancing forces you to trim them and redeploy money into bonds, which have underperformed and become cheaper. When bonds eventually outperform again, you're positioned with more of them. This systematic approach to buying low and selling high is one of the most reliable ways to enhance long-term returns without taking on additional risk or needing superior market timing ability. How often should you rebalance? There are several approaches. Some investors rebalance annually on a specific date, like their birthday or New Year's Day. Others rebalance whenever their allocation drifts beyond a certain threshold, say 5% away from their target. Still others rebalance whenever they contribute new money to their portfolio. All of these approaches work fine. The key is consistency and discipline. Pick an approach that feels sustainable for you and stick with it. One beautiful aspect of rebalancing is that it costs very little in a tax-advantaged account like an IRA or a 401k. These accounts don't trigger capital gains taxes when you sell and buy. If you're holding your portfolio in a regular taxable brokerage account, you need to be more thoughtful about rebalancing because sales trigger capital gains taxes. In that scenario, you might consider using new contributions to rebalance, or you might rebalance less frequently to minimize tax drag. This is definitely worth discussing with a tax professional if you're managing a large taxable account. Now let's dive into dividend yield reinvestment, which is a concept that confuses many investors, but is actually beautifully straightforward. Both VTI and BND pay dividends. VTI pays dividends because the underlying companies pay dividends to shareholders. BND pays dividends because the underlying bonds pay interest. These dividend payments are typically paid out to you in cash, several times per year. But here's the key. You can elect to have these dividends automatically reinvested back into the funds themselves. When you reinvest dividends, you're taking those cash payouts and using them to buy more shares of VTI and BND automatically. This might seem like a minor administrative detail, but over 20 years, reinvested dividends create dramatic differences in your final wealth. Let's look at the numbers. Suppose you started with $25,000 in a 70-30 portfolio with no additional contributions. If you took your dividends as cash and spent them, you'd have that original portfolio growing at its base rate. But if you reinvested those dividends, you'd be continuously buying more shares, which themselves pay dividends, which get reinvested again. This is compound growth in its purest form. Historically, VTI has yielded around 1.5 to 2% annually. BND has yielded around 3 to 4% annually. On a 70-30 portfolio, your blended yield might be around 2 to 2.5% per year. Over 20 years, if you're reinvesting that yield, you're essentially getting a free boost to your returns. This boost comes from the power of compounding. Your dividends buy more shares, those shares pay more dividends, and the cycle continues. This is why Warren Buffett calls compound interest the eighth wonder of the world. One practical note. Most brokerage firms make dividend reinvestment automatic by default, but you should check your account settings to confirm. Log in, find your account preferences, and verify that dividend reinvestment is turned on. This one-time check could literally add tens of thousands of dollars to your wealth over 2 decades. It's perhaps the easiest wealth-building decision you'll make, and yet many investors overlook it entirely. Let's now turn our attention to safety metrics. When we talk about portfolio safety, we're really discussing several interconnected ideas. First is volatility, which measures how much your portfolio value fluctuates day to day and year to year. Second is drawdown, which measures the maximum peak to trough decline you might experience during a market correction. Third is recovery time, which measures how long it typically takes to bounce back from losses. And fourth is stress testing, which means understanding what could go wrong and whether you could handle it emotionally and financially. VTI represents the stock market. The stock market is inherently volatile. On some days, VTI will jump 2 or 3%. On other days, it will fall by the same amount. VTI might be up 20% or down 15%. This volatility is the price you pay for the long-term growth that stocks provide. However, this volatility is also temporary. Over rolling 10-year periods, stock market returns smooth out considerably. Over rolling 20-year periods, they smooth out even more. Time is the great volatility reducer. BND, by contrast, is much less volatile. Bonds don't jump around nearly as much as stocks. In a typical year, BND might only move 3 to 5%. This makes bonds incredibly valuable as a volatility dampener. When you combine 70% VTI with 30% BND, You create a portfolio that's less volatile than pure stocks, but far more growth-oriented than pure bonds. This blended approach is the reason this two-fund portfolio works so well for so many people. Let's talk about maximum drawdown, which is perhaps the most emotionally relevant safety metric. Maximum drawdown is the biggest percentage decline you might experience from peak to trough during a market crisis. In 2008, the worst financial crisis since the Great Depression, a pure stock portfolio in VTI fell about 55%. That's genuinely terrifying for most people. However, a 70-30 portfolio would have fallen only about 38%. That's still significant, but it's substantially more bearable. A 50-50 portfolio would have fallen about 25%. The bond component absolutely cushioned the blow. Now here's the critical question. Could you have handled watching your portfolio decline 38% without selling in panic? This is where asset allocation connects directly to your personal safety and success. If a 38% decline would have triggered panic selling, then 70-30 was too aggressive for you personally. If a 38% decline would have been uncomfortable but manageable, then 70-30 might be appropriate. If you didn't even flinch and thought it was a buying opportunity, then 80-20 or 90-10 might suit you better. This is deeply personal. Recovery time is also worth understanding. After the 2008 crash, it took roughly 4 years for the stock market to fully recover to previous highs. For a 70-30 portfolio, recovery was slightly faster, around 3.5 years. This is still a meaningful period, but it's important to remember that recovery happens automatically without you doing anything. You didn't need to time a comeback, you didn't need to sell at the bottom and buy at the top. You just held, and recovery happened through the natural healing of markets and the reinvestment of dividends into cheaper assets. Let's now construct a 20-year timeline and see how this portfolio might evolve. Imagine it's January of 2025, and you're starting your VTI and BND journey with $100,000. Your target allocation is 70-30. You invest $70,000 in VTI and $30,000 in BND. You set up dividend reinvestment, mark your calendar for annual rebalancing in January, and you commit to contributing an additional $5,000 annually.